Excel accounting practice problem. Create accounting worksheet part number 11. Get ready because we're about to excel with Excel. Here we are in our Excel worksheet. In prior presentations, we put this together from a blank sheet. Continuing on here, if you have access to this workbook, there's going to be two tabs down below, example and practice. Example tab in essence being an answer key. Let's take a look at it now. In prior presentations, we started out all the way on the left, entering the space where we're going to put financial transactions. We're going to post them to the trial balance as well as to the general ledger that we then created. Then we created the subsidiary ledgers way after the trial balance. In the accounts receivable subsidiary ledger, the accounts payable subsidiary ledger, the inventory in essence subsidiary ledger. Now then, we looked at the balance sheet, creating the financial statement, starting with the balance sheet, which is a little bit backwards to what you might see in a textbook. But if you have a good trial balance, I like starting with the balance sheet if it's set up in this format. Then the income statement we created. Now we're looking at the statement of equity. The statement of equity, in essence, tying the balance sheet to the income statement, showing how the balance sheet and the income statement are related. In essence, how the income statement is part of the equity section. We were basically breaking out the equity section to create the income statement and give us that sense of time instead of just a point in time. So let's go to the second tab, the practice tab. I'm going to go all the way back to the left just to see the same information. We've got our data where we're going to put in the transactions, the trial balance. We got the huge general ledger then going all the way to the right, we've got the accounts receivable subsidiary ledger, accounts payable subsidiary ledger, and then we're on the inventory subsidiary ledger, balance sheet, and the income statement. I want to create the statement of equity. I'd like to keep the balance sheet and income statement around to do that, however, because the statement of equity will basically be pulling those two things together. Therefore, I'm going to hide some cells, but I'm going to be keeping the balance sheet and income statement. I'm going to hide everything on over to the trial balance again. So I'm going to put my cursor on AX or BX and go all the way back to the trial balance and hide as we have seen in the past. So we have our information as close as possible to the data that we're using to create. We're going to right click on this area and hide. So now we have our trial balance over here, balance sheet and income statement. We're going to be creating our financial statement from the ending balances. Therefore, I can further hide column G and H. So I'm going to hide column G and H, selecting those two, right click and hide. So then here is our income, here is our trial balance, our balance sheet, and the income statement. So our statement of equity is in essence going to break out this ending equity balance, which you'll recall we got this time on the balance sheet nice and easily by just summing up, taking the negative sum of the equity accounts and the income statement accounts, or in other words, you could think about this number as the beginning equity. This is basically the key to try to understand how these things are related and how the trial balance works. So in other words, if I look at the trial balance, this trial balance is as of the end of the period, let's say the end of the year, like 12/31, December 31st. But the key is these numbers on the balance sheet represent points in time because they're balance sheet type of accounts, otherwise known as permanent accounts as opposed to temporary accounts. And therefore, they are posted as of the end of that time frame. These accounts down below, the income statement accounts, are what we would call temporary accounts, accounts that clear out to zero at the end of each period and then start at zero in a similar way as if you were to drive a car and see how long you can drive within like a day or something like that. If you wanted to reset the odometer to zero to count the miles from zero, that would be a similar kind of analogy. And then these accounts, or let's just look at this equity account. This equity account then represents a balance sheet account. We could see it right here in the equity account. So you would think it would represent the balance as of the end of the year on the trial balance, like all other balance sheet accounts, but it doesn't, because that's where the little trick comes in with the trial balance. Really, all this stuff down below is basically the activity that's going to feed into the equity account, this equity account here. So every transaction that hits an income statement account, revenue or expenses, we could just think about it as just hitting the equity account and we'd be in balance. but we wouldn't have the added detail of timing. So that's what we're doing down here. All this stuff down here is part of equity in essence. And that's why if you have it set up in this format, you can basically just sum up the equity accounts and you're going to get a credit balance generally. And that credit balance, credits minus the debits, is basically the end number. That's the ending equity. And this number that's on the balance sheet is basically the beginning equity, unless something was posted to the equity account. Now, how would you know if anything was posted to the equity account or the retained earnings if it was a corporation, or a partnership account? If it was a partnership equity or capital account, well, then you can look at the general ledger and look at the detail in those accounts to see if anything was posted there. What might be posted oftentimes to an equity account? Well, you're going to have the closing process of the prior period, and that's normal. And then you might have basically draws posted to it. So in other words, draws could be posted directly. Draws meaning money that was taken out of the company, paid to the owner, which it would be called draws oftentimes for a sole proprietorship or for a partnership for individual partners. Or if it was a corporation, it would be similar to dividends, dividends being revenue that has been taken and given back to the company. So you could think about these as kind of this draws account as in essence similar to the accumulated depreciation. Accumulated depreciation, as we saw, being a contra asset account. Draws can kind of be seen as a contra equity account. Equity typically having a credit balance, draws then having a debit balance, and instead of netting them out to equity, we kind of break them out into their own account. Therefore, they're a timing account that show the draws that are happening over a certain period generally. That's kind of the general concept. The other thing that could be in this equity account would be investments from the owner. If I'm the owner, I put money in to the company, then that's another thing that could have an impact on the equity section. We could break out another account called owner investments that would be similar to draws, except the money's going the other way from the owner into the company. It's less often done that way. Oftentimes, if I, the owner, put money into the company, it will go directly into the equity account or capital account. In a corporation, then that would be like usually the issuance of more stock, common stock, and the recording of that issuance of the common stock would be a similar scenario where you've got owners, shareholders putting money into the company. Okay, so that's going to be the general idea. So we can already get to the end number. That's why we were able to do the balance sheet first, because it's so easy in this setup to just see that this whole thing adds up to the second half. In other words, the first half is assets minus liabilities, debits minus the credits. That gives us to 116,775. Second half is all the equity accounts, everything in blue, equity accounts, beginning balance, plus the temporary accounts of draws and the income statement accounts, 116,775. So now we could just basically link those two things together. Note that you might see them linked together if it was a simple format like this. Oftentimes you could do it basically on the balance sheet, kind of like what QuickBooks does. They try to break out this equity account and show the income statement. That's unusual in financial reporting, but I think they're trying to just show people how it's related. It's more likely that you'll see it like on the income statement if it was nice and simple like this, and you would see the 24,000 plus the beginning balance here. You could say the beginning balance in equity is that, or I could just basically say negative of that, and then I could sum these up, and I get to that 116,775. Now that gets more complex to do that if you had draws involved, investments involved. That's why you can't do it really automatically in something like a QuickBooks software. That's why they kind of try to put it over here. Also note that if you have a partnership, either methods are going to be much more difficult because you're going to have multiple capital accounts, and that system doesn't work very well. You're going to need then a statement of equity, a separate statement of equity generally. So let's make another statement, and I'll put that over here. And I'm going to make this another small column. We'll make this a small column. And then I'm just going to call this statement of equity. You could call it, if it was a sole proprietorship, statement of owner's equity, partnership, statement of partnerships equity or partner's equity. And if it was a corporation, it's possibly statement of retained earnings. So we got, or shareholders equity. So statement of equity. So generic name here, I'm going to basically make this black and white. I'm going to make it black and white, not really basically. Don't need to qualify that. We're going to make it black and white. Okay, so then we're going to pick up our account. So I'm going to pick the first one up, which is going to be called beginning equity. And I'm going to put this in the outer column. So I'm going to put it outside here. And this is often the way you'll see kind of a basic equity statement. And I'm going to pull that from the equity balance. Even though these balances say right here they're the ending trial balance, and that's a balance sheet account, that will typically be the beginning equity. That's the key. That's the twist, that's the trick in a trial balance. The only time it wouldn't be, and oftentimes if you're doing this on like a tax system, you want to tie that equity out to the prior year. That equity on the ending trial balance should equal the total equity from the prior year that's in the equity section. If it doesn't, it's likely if one of two things have happened. You check then the general ledger account to see if anything has been posted to this equity account, like draws or like an investment. That should be the difference. If it's not, it's likely that some prior period transaction happened, such as someone voided a check in the prior period, change in the income statement prior year, which makes your beginning balances thrown off. Quite common for small businesses. Okay, so we're going to say enter. You might say, how would we fix that? Well, that's beyond the scope here. We'll talk about that later, but you can basically compare the two things out. But in any case, now I want it to be positive, so I'm going to double click on that, and then let's put a negative in front of the first letter here, and that'll make it a positive number because we're converting from debits and credit format to a plus and minus format. And then oftentimes you'll have something called change in equity, which is recording the difference or the change in the equity. And it might be named increase in equity, or net increase might be a better name for it, because usually there's going to be an increase if the income was higher than the draws. If you had a loss, then it would be decrease in equity. So then we're going to say owner's draws. I'm going to pick up the draws here. So, and you might say, minus draws or something like that, but I'll pick up the draws since it's the first number. This is going to be equal to, I know it's 0, but I'm going to be picking up the draws. And then I'm going to call this, whoops, that's the wrong cell. Let's put it where it's supposed to go. Make it go where it's supposed to. All right, here we go. And then we're going to say that we have the net income. So the net income, traditionally you'll pull from the income statement here, but I'm first going to pull it just from the trial balance, because just note how easy it is to do. You can either say, and I'm going to say negative to flip the sign, because the net income's represented over here as a credit. I could pull it from right there, the 24,710. That's one way I can do it. Or I could say negative sum of these accounts, all of the income statement accounts starting at sales on down. I could pick that up, and so I can do it that way. And the reason I can do that is because we set this up so that the credits are negative and the debits are positive, making this a nice simple formula for us to be able to calculate this out. So there we have it again. And then I'm going to underline this one, font group, and underline. And this will be the total, let's call it total change in equity, putting this in the outer column. This is going to be it should be 24,000 minus the draws, if there's draws. And that's going to be the 24,700. Going to underline that. And that'll give us then the ending balance. Let's call it ending equity, which often would be represented by a date. I could sum up this outer column now, summing this up, and that'll give us our 116, and that ties out to this 116 here. So then I'm just going to do some formatting. Let's do some indentations here by going to the Home tab, Alignment, Indent. This one too, Home tab, Alignment, Indent. Let's bring this one out a bit for the formatting. I'm going to say format, paint that out one more. Let's put a double underline here, font group, and then double underline. And we're going to do one more comparison to tie out these statements a little bit more clearly. So after I'm done with the formatting, we'll do a little bit more here. And then I'm going to select these cells and make that bordered in blue. This blue here found in the More Colors standard, making that blue right there. So there we have that. Okay, then I've been centering this across. Let's center this across, not with this center here, but rather by right-clicking on it, format, painting it, alignment tab, and then we're going to go to the horizontal and center it across. There we have that. I'm going to center this one across too, because we didn't do that last time. I'm going to do that. You should have reminded me to do it last time. And then we're going to right click and we're going to format paint that one, alignment group, horizontal, and then we'll center that one across. And so there we have it. So now we can basically double check our work here. We could say, all right, does this thing work out? We got these two. Let's put some double underlines under these two. Put a double underline there. And there I could say, okay, this is in balance. I could see that is in balance. That makes sense. And then I know that the income statement comes out to the 24,710 here. That looks correct. This income statement should really tie out to this number there. So sometimes you might connect these together by saying, I'm going to say this number equals the 24,710. And everything should still feed out and tie out. We should still have a green zero there to do that instead of taking it from the trial balance. And then we see that this 116 is the same as this number in the equity section on the balance sheet, which once again, instead of on the balance sheet, instead of us taking it from the balance sheet, which I kind of like to start with to do as my starting point, instead of taking that from the trial balance, summing all the blue areas, we might want to change it now and say this should equal the amount from the equity section, and that change should keep us in balance here, assets still equaling liabilities plus equity. So if I checked all my numbers, if something was wrong here, I could check them one by one. Given the fact that this is lined up nice and easy, I could say, okay, assets should be these. The contra assets negative, there's the 118,375, there it is. If there was a problem with that, I could say, okay, the current assets tie out to these, 106,375, 106,375, and then this number minus the contra asset 12, and check those two components. Liabilities, these are credits, negative numbers. Over here, they're positive, but they should add up, of course, to that 1,006. They do. Equity then should be, total equity should be this entire thing. Now, if you had a more and that should be 116,775, I could see that ties out here. If you had a more complex problem with draws and with owner investments and or partnership or corporation, it can get a little bit complex to see different components here, different capital accounts for partnership, retained earnings versus the common stock and so on for a corporation. But in total, you can tie this out nice and easy. In total, it's all the same concept. And then on the income statement, I can check nice and easily that my revenue, of course, is just simply 200,000, which I had to flip the sign for because I'm converting from debits and credits to a plus and minus. Expenses should simply be the sum of these, 175,290, 175,290 on the expenses. And then we've got the total net income should just be the sum of all of these, which we calculated down below here to 24,710. That's a credit. We're going to flip the sign here. It should be a positive number because it's income 24,710. And then clearly the ending of the statement of owner's equity should equal assets and liabilities. Assets minus liabilities, 116,775 equals all equity, all the blue items, 116,775, tying out to the equity amount on the statement of equity. So this process, you could do the same process if you had a trial balance in other formats, if you had a piece of paper with a trial balance that had two columns on it and so on. But just the ability to kind of convert is, I think, as streamlined as it can be if you set up your trial balance in this format, allowing you to pull your information directly from the trial balance, allowing you to double check each section as easily as possible with the most simple type of formats as possible.